Andrade joins us now, and let's take a conversation forward. I always look forward to engaging conversations. Kenneth, my friend, so nice to have you back. How are things?
All well, Nico. It's good to be back. Thank you very much.
So, what's keeping you busy these days?
Hmm. Um, it's a buoyant market, so there's not much to do. What you have is going up, and what you sell is also going up. So no complaints on that. I think very watchful of where the earning cycle and valuations are both. And converse to where we were coming out of 2021, I think the entire industrial pack is doing extremely well compared to where the consumer part of the economy is. And I think that's interesting because uh, some of the companies in the industrial capex side of the market is now trading at significant premiums to where any of the large consumer names are. So watchful of that and how that transitions.
That's a great point that capital goods and capex dominated stocks are trading at multiples which are higher than that of consumers. So, time to
Mhm.
sell capex and go back to consumers?
No, I wouldn't say it that way. I think it's an allocation trade because because very simply the macros are completely in favor of what's happening in India as well as what's happening across the world. Now, you step back to 2020, where global capex seemed to, um, or governments globally seem to indicate that they would start the entire capex cycle when they all wanted to bring back capacities home. And I think you're seeing this continuation of the trend happening. So one of the biggest places of in inverted commas growth that you would see is now the power market, or should I say power capex, and that could be a significant number if I look at anything that is linked to the past, right? So just assume that whatever India's GDP is today, okay, and we will spend that 1x GDP over the next 15 years in putting up new energy capex or new power capex. Now that's a significant number to look for, and the beneficiaries in the chain and down the entire value chain are going to be one of the biggest beneficiaries that will be there. So that's where we are. So I wouldn't say it's early to sell, but I mean it's really back-ended earnings that you have to put a valuation on today.
You have Pharma as your top holding. If I look
Mm-hmm.
at the top 10 holdings in public domain, it's Aurobindo Pharma and there's Marksans Pharma.
Mm-hmm.
That's very unusual of you, right? You normally like to buy companies which are in monopoly, which are not deep cyclical. Here's Aurobindo Pharma and Marksans Pharma. They have debt on their balance sheet. These are cyclical businesses and they've gone through volatility of what has happened in the US generic market. Why is Pharma popping up as one of your top holdings?
Well, simply put, we've got four names out there, and all of them lead their entire verticals or the categories, whether it's in India or whether it's across the entire world, right? So one of the names are obviously the world's largest generic manufacturer of pharmaceuticals, and it's going backwards into and the capex cycle for him is almost over. So capex in place, category leader, and over the course of the last I would say 5 years, the industry actually has cleaned up its balance sheet. So they are net cash positive rather than having debt on their balance sheet. So the net cash positive, earnings growth. I won't say earnings growth, but the ability to generate significant amount of profitability from significant amount of profitability from the existing capex. I think all of that is in place, and it's a cycle that I think started off in 2020, and we made a low somewhere in 2022 before you're seeing the industry hitting all-time highs in terms of profitability. So this 2024, um, okay, and probably 2025 will be years where this industry will hit its all-time high in terms of profitability and cash flow generation. Plus, you got the opportunity of another patent peak coming in between 2026 and 2030. So you got growth, you got clean balance sheets, you got category leaders, and you got valuations which are not really where they used to be in 2015 2015. They're significantly below where they used to be in 2015.
Where else do you see this combination of business, which is operating leverage growth, and balance sheet, which is financial leverage, play out in next couple of quarters and years?
Hmm. I think, Nikhil, it's across the board. I wouldn't say it's specific for pharma. I think the only gap that is missing in all of this is is where valuations are, right? And that's a tricky one because when you have a corporate India with historic low debt to equity, corporate India at historic low debt to equity, valuations will be at its all-time high, right? And converse to that is when when debt expands or when corporate India starts leveraging up its entire balance sheets, you will see valuations actually correct. So we are not really in that zone right now. Let's wait till that corporate India gets significantly um, runs out of capital. It depends upon the entire financial system to leverage its balance sheet and go for growth. I think that's when you'll have a narrowing of valuations coming in.
Don't have banks. You don't have financials. Why is
Mhm.
that?
Oh, that's an historic trait. I think we chose to be on the asset side and not on the liability side. So the way we think about it is that if you have an economic expansion, not just the liability side or the lenders will grow, you'll also have the other side of the entire business, right? Which is what the banks lend to. And I think that's where we prefer to stay because on the asset side you got free cash flow generation, which is very important to us. You got no debt, which is extremely important to us. So you have no mortality risk as far as that is concerned. So this is a place where we prefer to play. And then it's also where you are as far as valuations are concerned. We did one lending business transaction that was one transaction in lending, which is on our balance sheet, and that was when it was at its historic low in valuations. Plus, it was generating, if I could say, free cash because the leverage cycle for this business wasn't going up. So that those are spaces that we like to be, and whether it is banks or financials or whether it is the other side of the balance sheet, which is asset businesses, I think uh, that's paramount to us to keep hygiene in our investment thought process.
Uh, so can I say that right now your approach is very bottoms up, does not matter what the sector is doing, doesn't matter what is happening to the macros, because if you've got names like Aurobindo Pharma, Interglobe, Radico Khaitan, Prestige, IEX, they're just not related. It's not like you're betting on financials or you're betting on IT or you're betting on consumer. You're simply betting on companies.
Yes, yes. I think the big macro trade or the directional trade is obviously going to be capex and industrials, and everything else is going to be you have to go down there and uh, do stock picking. I mean, look at one of the index heavyweights, which is IT, I mean banks and IT both together. And if you break up the companies out there, every single business out there, it is more stock picking out there than actually saying that the industry is going to do well. So you're right in that way. The breadth of the market in the non capex infrastructure industrials is narrowing significantly to stocks and not really to any particular industry.
Kenneth, where do you think the global cycle is headed per se? Because that is important for us to understand how will sectors like metals, exports, and pharma they would move.
Well, what's happening in India is also happening across the world. I mean, if you look at globally, what stocks are doing well, apart from what's happening in the US, uh, which has all the eyeballs, right? The industrial side of that market is also is extremely robust. So let's put it this way: global GDP growth is held up by defense. Okay, it's held up by industrial capex, which is putting in an enormous amount of power. Governments are going to be the largest spenders, and consumers are taking a backseat for a couple of years as inflation raises head. Now, when governments put their balance sheets to work as far on the capex side, or on rebuilding their entire industry and taking capacities back home, obviously they have to generate cash from somewhere, and that's where the inflation cycle is actually sitting. So I think it's a little bit about everything. I'm extremely favorable on the commodity side of the entire business, because what we see on every single element, whether it's defense, whether it's power capex, whether it's putting up of commodity capacities across the entire world, it's trending towards its all-time high.
Okay. Kenneth, if I look at the IT numbers, all of them are claiming that order books are at a record high, which means business is coming. But if I look at the execution, and it is not a one quarter phenomenon, it's been 4-5 quarters where orders have been strong, and that is not getting translated into real volume growth. IT companies are maintaining that, okay, this is a delay and it is not a problem, this is not a dead end, this is more like a speed bump. Would you buy into the commentary and the optimism or the optimistic picture some of the IT companies are painting, that business is only growing and order books are a indication of that?
Well, because if you look at how all of these companies actually ramped up, you saw a significant amount of hiring by a lot of these companies post-COVID, in the expectation that all this order book would actually ramp up. And to an extent, I'm relatively, pleased to see the fact that these numbers haven't ramped up, and now they are actually cutting headcounts. Okay, so the growth in headcount is not as much as it has been in the past. So whenever these orders actually ramp through, you'll have two things actually playing out. You'll see costs going steady, and then revenue is actually coming back again. Now, whether it is going to happen in this year, or whether it's going to happen in next year, or even it probably in 2027, that will happen. I can't time it, but the numbers are good. The balance sheets are strong. It's a fairly mature business, so you wouldn't expect any of these companies to hit it out of the park. And if I go back to past track record, all of these, or most of these companies, have doubled every once in 5 years. I don't see that trend changing anything very significantly from what we've seen in the past. So yes, to that extent, I believe most of them it will happen, because we are the largest in the world as far as IT outsourcing is concerned. So that's going to remain a static phase, should I say? And the growth, you will see it come in a year, maybe two.
You don't own defense. You don't have exposure to PSUs. Now, at a time when we're talking about capex, defense and railways are two sectors where capex is the strongest. And PSU companies would be the big beneficiary, because this is a government-backed capex where government is spending a lot in building the new India. Why is that you've shied away?
I think we have preferences on how to play this entire cycle, and we're more clear on how to do it on the commodity side of the business, because that's where you have huge free cash flow generation. I think we stick with that cycle as there. Anything which is private sector capex, we have aligned to that entire marketplace.
Any reason why there is no Zomato or a Paytm or a Policy Bazaar in your portfolio? They are also the future businesses.
I think that will come through, but we bias in the second cycle. We'll see these markets mature. We will see these markets correct themselves, because every business is cyclical in nature. Like you're seeing what's happening in consumers at this point in time, and we've had virtually no consumers, and like I said, the valuation actually flipped in favor of these companies today. So we're happy buyers. All of these are on our tracking radar. But we will choose where to allocate capital in these businesses, when we do not have to guess what the future is going to be like.
Kenneth, at the current juncture, the general view is that small caps are reaching what could be called as a bubble zone. Does not matter what the color of the companies, does not matter what the business cycle is, small caps is bubble and trouble. Is that a very myopic kind of a view?
Well, I spent most of my life watching this space, whether it's small caps or mid caps, and I've seen this come up in the past. So I think you got to tread careful when you head into these entire head into allocating money into all of these companies, and to be fair, the mortality risk in this industry, in this category of businesses, it, it is high. It is extremely high. So buying at high valuations is not something that I subscribe to. So when you are in this industry or when you're in this category of companies, you have to be very cognizant of the fact that you got to buy it with a very high margin of safety, and you need to know what you do, right? So this is a place that I choose to be in, because this is essentially where you get the $100 million companies becoming $1 billion companies, and there are enough of minefields out there. So valuations today on a broad basis is high. I would like to see this category of companies actually consolidate. I would expect this year to be quiet for this segment of the entire market. Till now, it hasn't. It's been reasonably quiet still. And at the in 2025, I do see a large part of these industries these small companies from this segment of the market getting back to profitability, which is reasonably large.
One of the core of investment philosophies that you like to buy a monopolistic business. You like to buy companies which will gain because of consolidation in the sector. Can you give us a sense of where do you think big monopolies or moats are getting created in this economy?
I think the first thing that you look for is where capex actually stops. Okay, and if you go back to 2015 and 2020, I don't think you saw a single new power plant come up, and that's where you got the power deficit right now. Now, if you look at what's happening in some part of the consumer verticals, and airlines is a big case to it. Entertainment and to an extent media is a big case to it. Telecom is a large example of all of this essentially happening. And these are places where capex actually stopped, or entrepreneur. There was no new entrepreneur who got in, or new industry actually got into this. No new participant got into this business, and you would consistently have to go out there and look for something like this happening. Now, my sense is that the chemical market is fairly stressed, not just in India but across the entire world. Okay, and specifically agrochemicals. So that's one place that you could have this happen over the next 2, maybe 3 years. Okay, the consumer space, and you would see it where in the entire in the belly of the entire market, where middle class India is relatively stressed in terms of income levels compared to where inflation is, and also where household debts are. So this part of the mid market of the middle class part of the entire market is where they're cutting back on expenditure. I'm not saying that they're consuming less. Is what you can see with all results. Is there's an element of downtrading that is happening out there, and this is where we think you would get consolidation happening. Investment in that cycle is going to narrow down completely. So that's a space that I'd watch. Also, valuations out here will also react given where the environment is. So markets usually a lot of investors out there are more growth oriented, which is why capital moves in droves. I mean, which includes the lenders. It will always go for the marketplace which is growing the most. So we watch those spaces that will come through. I think it's an extended cycle. You will have to wait for 2-3 years before you can get something significant to buy. This is not my market. I mean, I'm not going to get anything which is going to be significant at this point in time. Significant movers or consolidating businesses at this point in time.
There are a lot of themes which, in a sense, are becoming very popular themes. One is EV, then there is energy transition, then there is climate change. Would you be playing at these so-called multi-billion-dollar companies, multi-billion-dollar themes now?
No, we're not participating in most of them. Okay, I think the most easiest way to invest is or allocate capital is into businesses which appear to be large and have no cash flows. But we are not in. We're not really there. We haven't. We haven't cracked the code on how to how to look at a large opportunity and then build a portfolio into it. We're more on the cash flow side of the entire business. We like to see businesses make money, which is why we usually come into some of these big opportunities when it's in their second cycle and not in the first cycle.
Kenneth, so at what time the trade of move out of capex to consumer will be at play?
Don't ask me that. It's 5 years plus for this one.
So you'll wait for 5 years plus for the trade to reverse, is it? I didn't get the last point.
I mean, you're asking me when will the trade reverse? It's more that it'll take its time. I mean, the previous decade, the previous cycle, when it flipped itself over, took almost a decade plus, right? So don't expect things to happen like. I mean, this is not a cycle which is going to flip itself over so soon. So you got to give this time.
Kenneth, history has taught us that the leader of a bull market will remain a leader. You may argue about valuations. You may say, okay, it is above the comfort zone at which a fund manager like you would like to buy. But the leader in a bull market can go to crazy numbers before the bull market ends. So can I say that that is why capex and this investment related themes are, yes, P multiples in ABB, Siemens, Thermax, they may be above historical averages. But if they are the leaders, you never know how much more they can go.
Yes, fine, but that's guesswork. We're not in the business of that, right? So so one of the statements that I usually make is our business is to buy efficient capital at a price. Okay, and everyone can get the efficient capital, but at what price are you paying for it? Those are the question marks that we ask ourselves, and which is why we 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 tend to be always in the non-consensus part of the market, and maybe a little early, but that's the risk that we actually take.
Consensus trade according to you right now is pharma. I mean, can I say that?
That's a continuing trend, and I mean, look where IT is today, right? It's the largest outsourcing platform for anything that's happening in the world, and look at generic pharma or pharmaceuticals that is there. It's just mapping that entire cycle that IT has been through. It's got cash flow. It's lowest cost manufacturer. It's the lowest cost manufacturer. It's getting market share. The international businesses, any generic business in the US is extremely leveraged. The balance sheets are in Indian companies' favors. The interest rates and inflation and interest rates going up are against the US. So it's a simple trade. Uh, we've got the capacity. We've got the both. We got the physical capacity. We got the financial capacity. The US businesses have none, and that's how it looks like going into a couple of years. So it's a small trade. It's not anywhere large as far as the indices are at this point in time. It's nowhere close to what the I mean, if you take 2035 up to 2035, the capex cycle, it looks huge. This is a relatively smaller part of the entire format, but we like it because they're large companies, and valuations, I can still argue that they're okay.
Construct of the market, earnings cycle, and where valuations are. If one looks at your current portfolio, what is in public domain, Orvindo, Interglobe, Radico Khaitan, public domain. I'm purely talking about the top 10 holdings here. Do you see them changing radically in next year or so, or you happy to stick to these stocks and you see earnings visibility for next 3 to 5 years in this current portfolio?
So whatever names we've got there, as far as the discretionary and consumer names are there are few, and there are tiny, there are very few names that are there. But back of the envelope, there is a migration of their business models, and the migration of the business models is to get customers who can pay. Okay, and that's the top end of India's consumers. So I think if you look at where India is, or any of the large developing nations, developing to developed nations are, these are categories that have done extremely well. So that's what we are. We've got the numbers out there. We've got the products out there. You can see the movement in each of these product pricings. I'm the firm believer that if there's any company out there who gets pricing up, who gets pricing power, will get price earning multiples. Okay, any business that is struggling to get pricing power, that's a place that you'll have to watch for on the other side, which is it's probably not going to enjoy premium multiples. So some of the names that you mentioned out there, some of the portfolio companies that we have there have got pricing power, have got very little competitive intensity in their category, and cash flows are significant.
All right, Kenneth. Really appreciate your time and thank you for joining us with your
Okay,
valuable inputs.
thank you very much.